Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Goals, then plan, then portfolio. Your topic, Dallas.
Thanks, Michael. We've discussed this a bit in the past, but this is a response to a question that we often hear. I was about to say when we go to the pub, but we don't really go to the pub anymore, you and I, with young kids. But it's something that we used to hear at pubs all the time. Now we hear it at first birthday parties and barbecues and things like that. When you tell people you're a financial planner, often their first question is, what's a good investment? What should I be invested in? Or, some variation of that. And what people are talking about there is what we would call their portfolio, which is of the money that they've got accumulated, their net worth, their retirement savings, whatever you want to call that, what we would call their portfolio of their investable assets. What they're really asking is, which assets should I buy, and specifically, how should I, invest in those assets with the money that I've got there? Now, it's kind of probably really obnoxious for people because we tend to give a bit of a non-answer and say, well, it depends, and it's a bit. What we really mean is that for our clients, I think when people think of a financial planner, they think that that's your main focus is on how do we invest this money and what we've got now and how do we work that. That tends to come at the very end of a three-part sort of process, as the title suggests. So the first thing that we look at with people is their goals, and it all sounds very it's sort of, like I say, a bit obnoxious probably when people just want to know should I buy NAB shares or not? We're talking about, what is the goal that we're trying to achieve here? What is the purpose, both of your financial life and then it flows through to your money? It's what are we looking to focus on? Now, someone who's 21 years old and just wants to buy a new car, their goals are going to be very different to someone who's 75 and just wants to make sure they don't run out of money. And it's very different to someone who's 50 and wants to get the balance right between saving for retirement and getting to travel and enjoy themselves now. So this is sort of what we talk about first, is that goals piece.
Yeah, look, and you could replace goals with where do you want to end up?
Yeah.
Or where do you need to end up is probably even better, question mark. And really that sort of helps frame it helps frame everything else after that, but it has to be done first. There are people that can be retired on $40,000 a year and live a very, very comfortable and fulfilled retirement. There are other people that 3 times that amount won't cut it. So you have no hope. Before you work that out, and there's more inputs into that, such as the length of time between now and retirement and a host of various other things. Before any of that is done, you actually have no, the second part is useless. The plan part is useless. Goals, then plan, then portfolio. So it's all a logical order.
Yeah.
But to even move to the plan part, which is step 2, you cannot put that before any of the other parts. It is goals, or where do you want to end up?
I think that's a great point there, is that a lot of people that we talk to are even, I don't know any other good shorthand way of saying it other than goals, but we're not normally talking about goals. Goals sounds a bit woo-woo and a bit like I'm going to write this on my vision board and, envisage it like The Secret and whatever will manifest my future or whatever. What we're really just talking about here is, where do you want to end up, or what would you be happy with is sort of another way I think of it. When we're talking to someone who's 55 and we talk about what are your retirement goals, they normally look at you like, well, I don't know. I don't know what you mean. What do you mean goals? Like, what am I?
And you could say, how much money do you need to live off each year?
Yeah.
Now, that's the other way to do it, is to say, if you're retired right now and you have an 18-year-old and a 16-year-old and you're 52, like imagine you didn't have the financial commitment of those the children because they're off your hands by the time you retire. Imagine you didn't have to pay tax. Imagine you didn't have to pay your mortgage. All of those types of things. How much would you need right now to live a really, really good retirement? And how much would you need? We'd have to repeat that next year. How much would you need next year? Is it 50,000? Is it 60,000? Is it 80,000? Is it 120,000?
Exactly right.
So,
and this is your point there, is that those goals or those amounts, they're different for everyone. So that's the beginning point here, is that for some people, what they need to live a fulfilled or happy or content, or whatever words you want to use there, their goals, even though we don't think of them as goals, what they need to be happy is going to be very different for different people. Now, I won't even get into the very conceptual thing of, well, we really need to be happy is some clean water and a roof over our head or anything like that. But I guess the point we're making here is that if you're used to a certain lifestyle and you don't intend to change that lifestyle, then that is your goal. Your goal is basically to maintain your current lifestyle. And for most people we talk to, that is what it is. They tend to go, I'm working now, I'm happy. Most of the types of people that we talk to are happy living the life they're living now. And if they're not happy now, generally I don't normally want to talk to them, because they're probably unhappy people for some other reason, and they're never going to be happy. So most people that we're talking to, they like their life. They're happy as they are. They just really want to be able to maintain that life. And what they really want is to maintain their current lifestyle and not run out of money. And so that's really part one, is that, like I say, it must be really obnoxious people when they ask me about how should we invest your money, or what's a good investment, and I start talking about, well, how much money do you need every year, and what's your lifestyle, and do you plan to travel in retirement, or will you have your home fully paid off, and all these sorts of things. But that's where we've got to start. We've got to start with that goal, or that retirement target, or that figure of what is the income that you would need to replace every year when we're looking at retirement planning. What is the income that we'd need to replace in order for you to be content in retirement? So that's goals.
Part two, the plan.
The plan. So this is, I guess, as you say, once we've got those goals, we then really we're normally at point A, and we've worked out that the goal is point B. And so we know where we are now, we know where we want to end up. The next step is to go, well, what do I need to do to move from A to B? And that's, a very, very small amount of that, as we'll flow through, is then the portfolio and how do I invest that money. And it matters. It does matter, and it matters more and more as you get closer to retirement. But it doesn't matter. It doesn't matter how well that money gets invested or what your portfolio is, if you don't have a plan in place that is going to get you from A to B. If you've got $500,000 in superannuation right now, and we work out that based on your goals, you really need about $1.5 million, we need a plan for how are we going to grow that money. And some of that will be to, work that money for you, and some of it will be you sacrificing, you giving up money each year to contribute into super, or it might be selling an asset down the road, or it might be some variation of that. But there needs to be a realistic plan for how am I going to get from A to B, and that's what we're talking about with that plan, is that what's the path that we're going to draw out here that you're going to roughly be able to follow over the next 10 years, and realistic is the key there for me.
Realistic is the key. As we tap into to tax deductions and legislation and low hanging fruit and all those types of things. Yeah. But yes, to have a realistic plan. Yeah. Of attack to get to the position that they need to be in, as determined by the first section, the goals section, or the where do you need to be, or how much would you need to live off in retirement if you're retired right now. Certainly, it has to be realistic. Yeah, that part two. Part three, the portfolio.
So we finally now have answered the question that someone has asked me at a barbecue 10 minutes ago now after I've tortured them. But I think the point here is that then when we look at, and we've discussed this in great detail on this podcast about different assets that you can own leading up to retirement, and in retirement, what's going to be able to provide you a rising income stream throughout your retirement, all that kind of thing. It's sort of the way that I think about your portfolio or how you have that money invested is that there's only, I think the big danger here is paying too much. You got to get this right, and you want that money working as hard as possible for you, and you want that to line up to your plan and your goals, and you want that invested in the right way according to what you need. But you can't squeeze that beyond what's, again, going back to what's realistic. Where I think it gets dangerous is that if you look at your portfolio and go, well, we need a 7-8% return over the next 10 years to get where we need to be, can we achieve that through being diversified and being safe in how we invest that money? That's great. Then we sort of progress based on that. But if you look at that and you go, the only way that I can get where I need to be, the only way that I can fit in with my plan is if I get a 25% return every year, you then got to go back to start. Because I think anytime that you find yourself having to try and work the portfolio much harder than what is safe just to try and line it up with your plan and with your goals, you then it ends up being a bit of wishful thinking. So you can try and work on saying, well, we might get an above average return over the next 10 years, but you're then getting into the territory where you've gone away from something that you can control, and you're now just hoping and sort of cross your fingers and try and see where you end up. Whereas, yeah, it
distracts a lot of people as well, and I've had clients come to me, and one in particular stands out. They had a self-managed superannuation fund, and they ran their own portfolio of individual companies that they were investing into, and they had about 25 companies in there that they were investing into. That distracted them. The whole process of going through and working out that this one was underperforming and this one was growing well, and what do we do with this one here? It's just gone flat and it hasn't done it. That all distracted them from the fact that what they really needed to do, besides all of that, was they needed to be putting about $40,000 a year into their superannuation fund.
Yep.
And when we had a look at it, we went back, looked at the goals first, worked out where they need to be, worked out that they needed to be putting in, $40,000 a year between them.
Yeah.
And then we looked at the portfolio. Now they'd got that about face.
Yes.
They'd got that.
Yep. They were looking at how to earn money first,
and that was distracted. All of their time was being taken up by this company over that company.
Yep.
And
yes,
they looked at me like I had two heads at the start when I said it doesn't really matter.
Yeah.
I would prefer you to be across 1,700 companies.
Yeah.
Now we can't run that ourselves.
But
this one over that one, I just kept going back to it doesn't really matter to me.
Yeah.
All this other stuff matters far more importantly than that. Yeah. So.
And that's a good point I think to make there, is that, like we've said many times, that financial planning isn't a set and forget process. And so when we look at this with our clients on an ongoing basis, this is a cycle that we go through, a process that we go through, is that it's a part of your reviews with our clients is looking at, okay, are your goals still the same? Do you still want the same thing in the future? Do you need to be in the same position to be happy? Are you happy to work as long as you intended? Do you want that to be shorter or longer or anything like that? Do you plan to spend more retirement? That sort of thing. So we need to start, even when you're reviewing this, you go back to the start with your goals. Okay, what needs to change there? And then you flow through to go, okay, well, if my goals have changed, what needs to change about my plan? And how do I need to amend that? Do I need to contribute more or less, or bring some things forward, push some things back? Then at the very end, you go, based on all those changes to my goals and to my plan, do I need to change my portfolio based on that? But that's I guess a key point there, is that you never make changes to the portfolio without first making changes to the plan. And that is a really dangerous way to get that backwards and to lose sight of what's really important, is to try and jump in and play around with the portfolio and change how that money's invested, month to month or week to week, when really the priority is, where is it that we're trying to get to, and what do we need to be doing consistently to get there?
And that's where we saw people come unstuck just recently when the markets fell by 37%.
Yep.
In the coronavirus depths in March of 2020. a lot of people made the critical mistake at that point in time of selling out of their portfolio.
Yep.
Let's just call it that.
Yep.
At 63 cents in the dollar.
Yes.
And there's a high correlation of those people that hadn't gone through the two previous steps.
Yep.
They hadn't gone through what their goals were. They hadn't come up with a plan. It was just a sum of money that they'd seen fall.
Yeah.
And of course, when you see a sum of money fall,
Yep.
and it doesn't have a job and it doesn't have a purpose, and
Yes.
there is no plan, and there is no point in time where you need to be in a specific position, of course you're more prone to actually trying to stop the pain.
That's right.
And selling out. You know, in this case, for a lot of people, it's 63 cents in the dollar.
That's a great point, and obviously anyone who's a long time listener to the podcast will know that about a mentor of ours, Nick Murray, who talks a lot about this sort of behavioural approach to investing. And one of the things that he says, which is that all unsuccessful investing is reacting to market movements, and all successful investing is acting based on a plan. And this is the point I think you're touching on there, is that, and this is sort of what I've been saying from that process of going goals, then plan, then portfolio, is that when things change, when there's a drop like there was in March of 2020, if you approach it with the attitude of, firstly, my super balance has dropped by 35%. It's painful to watch. It's painful to live through. Have my goals changed? No. I still want and need to be building up my retirement savings over the next 8 years to be able to retire. My plan is to continue to max out my contributions every year. I'm going to put $1,000 a week into super, and that's what I'm doing. Now, once you look at that and go, well, my goals haven't changed, my plan hasn't changed, I know then that my portfolio shouldn't change, because nothing else has changed. The goals haven't changed, the plan hasn't changed, the portfolio does not need to change. If you, as you say, if you approach that the other way and go, the portfolio has dropped, what's my goal? What's my plan? I don't know. I don't have one. What happens is subconsciously, if we don't have a plan, subconsciously our only goal becomes stop the pain in that moment. And that's how people react to those big drops. Well, if I don't really know what the purpose of that money is, and I just kind of want it to be growing for some reason, and I see it dropping, it hurts, and I want to stop that pain, and so I'm going to sell and move that into cash, even though that's going to cost me a lot of money, and even though that's actually taking me away from what my goals really are, and the plan is that I should really be following.
Thanks for listening, and before you hit the back browser to go to your next podcast, there's 5 empty stars that need to be filled up. Could you guys, like, the natural resting state for us is to be full. Can you, in all seriousness, if you could leave us a quick review on the podcast
player of your choice,
a player of your choice,
as you say, Michael.
There's 5 empty stars there that want to be filled up. So please fill those stars up before you search for your next podcast.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.